Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. I'm sure you're hearing a lot about recession. Well, so are the CEOs of major companies. A survey by PwC during the World Economic Forum found that never before have so many CEOs been so pessimistic about the short-term future. While this is on the backdrop of the story being played out in the US that the inflation has peaked and Fed might start cutting rates towards the end of the year. On the Japanese front, we observe the pressure on BOJ to expand its 10-year bond ceiling as the market functioning tumbled down with the only major buyer of the bonds being the BOJ. JK, what are your thoughts on this lot of developments? How are you seeing the markets?
Good morning, Swaraj. As we come out from a relatively quiet period after the weekend, we have started the day with a slight grim, mood. And as you said, the elite gathering in Davos has begun yesterday, and the many economists and business leaders are expecting a global recession in 2023. And in fact, majority is on that side. The big three risks are inflation, macroeconomic volatility, and geopolitical conflict, as per the survey. And the geopolitical risks from Russia and China, and even Iran, being already known. An unknown risk can also come from the Inflation Reduction Act from USA, for the particularly for some of the major economies. So that's something the some grim note on which the Davos meeting has started. And on the global side, we have China, which published the macro data on retail sales, GDP, and industrial production. GDP for 2022 was at 3%, far below the official target of around 5.5%, and excluding the 2.2% rate that was recorded after the COVID in 2020. It is the worst showing by the economy in last 50 years. And the easing of public health restrictions as a part of the broader policy by China aimed at revitalizing economies recently is not really seen, to be spurring a big growth push, and many people are skeptical whether the growth rate will be realized as expected. And in fact, we are seeing demand for Chinese exports sinking as the global economy is slowing, consumer confidence is on the floor, and the 3 years of sporadic lockdowns, actually has been hitting the economy very badly. So it will be a long time, much longer than what people have been expecting, the bounce from China. Of course, the industrial production and retail sales beat the expectations, but definitely the growth concerns are overruling the sentiment. We'll also have UK unemployment rate today and the Canadian CPI to look forward to. Not much from the US, of course. We will have some speeches from Lagarde and a few other ECB officials. And while ECB has been sounding quite hawkish of late, it will be interesting to see how they speak today in the light of the recent drop in Eurozone inflation. As for the markets, they were quiet yesterday as expected, but the next onslaught of earnings from Goldman Sachs and Morgan Stanley can trigger the market moves. With the BOJ meeting tomorrow being the big event to look forward to, yields have been subdued, and decline in the rate of inflation of 2022. Yields have been subdued in the US markets, obviously, in the absence of US markets, of course. There is a minus slippage in Euro USD and GBP USD, with gains for the dollar coming, with the main contribution come from USD and also the Chinese yuan, which has seen perhaps the best level at below 6.70, and today's data on the GDP has actually spurred more buying in the USD against the Chinese yuan. On a day when global markets had little data to offer, India had its very important key macroeconomic data on trade as well as the WPI. Trade deficit remained high at 23.89 billion, and exports saw a drop by 12.24% on a year-on-year basis, while imports fell by a modest 2.09 billion. On a month-on basis, both of those have risen once again. Imports were much more than the exports. The rise of 219 billion in April-December period in merchandise deficit as compared to similar period of 2021 explains why our CAD has been at record high, and even accounting for a good performance on the services exports, there has been a pressure on funding the current account deficit. So obtaining oil from Russia at a deep discount has actually mitigated the deficit to some extent, without which we would have been in a far worse position as far as the external position is concerned. Funding the deficit has really been a challenge for us because the global financing conditions are tight and keeps the global investors on the sidelines despite the high growth prospects for the economy. In contrast, of course, WPI gave further relief to the economy by dropping even further to a two-year low of 4.95% in December from 5.85 in November. Decline in the rate is primarily contributed by fall in food articles, mineral oils, crude oil, and natural gas. Of course, for a perspective, I can say WPI, which had hit a high of 16.63 in May 22, and then we've seen a massive drop. However, the retail inflation has not shown much decline as desired and has just stayed around 6% for the last several months, although in the last 3 months it has stayed below it. The authorities are concerned definitely about the core inflation, which is sticky, and that probably will be guiding the policy rate by RBI in the coming meeting. Rupee for its own unique behavior did not show much strength, even though many other currencies hit new high like Australian dollar, Chinese yuan, and the Japanese yen, and 81.20 offered very good support once again for the second successive day. And what may be noted by the market is the steady bids from state-run banks at those levels. In fact, we moved as high as 81.70 yesterday before just dropping a bit. So it seems like we are building a good floor around 81 and not really swayed by the strength of other currencies against the dollar. Probably that is also coming to a level where we should see some good rebound in the dollar, particularly as the risk sentiment in the global markets really remains brittle. Thank you.
Thank you, JK. That was quite insightful. While the theme remains that majorly most of the market participants are expecting a global recession in 2023, we also discussed a fall in Chinese GDP to 3% against the target of 5%. And the story that will drive in 2023 will the lifting of the Chinese restrictions lead to a bounce back in growth? Data as of now does not paint an optimistic picture, with low consumer confidence and fall in demand for Chinese export. While on the markets front, there are a few speeches to look forward to, including that of the ECB chief Lagarde. We have a BOG meeting tomorrow, and whether they raise the ceiling of the 10-year bonds is something we'll find out. While on the domestic front, we discussed the Indian trade data deficit remained high, while exports fell more than the imports. So a current account deficit pressure remains for India. That's it for today. We'll see you all tomorrow with the latest round of updates. Thank you so much for listening. Have a good day.